Okay, let's dive right into this explainer. Today we're tackling a financial topic that touches almost every single household, and honestly, it's probably one of the most misunderstood. In India, we're kind of taught from day one that a good insurance policy is one where you eventually get all your money back. Like, ideally with a nice little bonus on top, right? We tend to view it as this safe savings account that just happens to pay out if something tragic happens. But I've got to challenge this traditional mindset. Today, we are going to completely replace that emotional money-back expectation with the cold, hard logic of opportunity cost.
So, ask yourself, are you mixing your finances? We really need to figure out if combining insurance and investment is actually a smart move for your long-term wealth. Because here's the thing, when you put a rupee into a policy that promises to both protect your life and grow your wealth, you're hit with an opportunity cost. That single rupee could have been doing one job perfectly, but instead, it's trying to do two jobs, well, poorly. And this brings us to a fundamental concept that is absolutely going to change how you view your entire portfolio.
I want you to keep a very specific, vibrant, visual metaphor in your head as we go through this explainer. Think of a shield and think of a sword. The shield is your insurance. Its one and only purpose, protection. It defends your family from catastrophic financial loss. Now the sword, that represents your investments, things like mutual funds or stocks. The sword is your attacking tool. It's built for wealth creation and slicing through inflation. You would literally never go into battle trying to attack an enemy with a shield, right? And you definitely wouldn't try to defend yourself from a heavy blow with just a sword. So why on earth do we insist on mixing their financial purposes? You should absolutely never mix the two.
Moving on to Section 1, Term Insurance, Pure Protection. Let's see exactly how a plain term policy acts as the ultimate foundation for your family.
Think of a term plan exactly the same way you think about your car or bike insurance. You pay a small premium every year just to cover the risk of an accident. Now, if the year passes and you don't crash your car, do you call up the insurance company and demand your premium back? Of course not. You're just happy you're safe. Well, term life insurance is exactly the same. It's pure risk cover. You pay a tiny premium, and if you survive the term, you get absolutely zero back. And I know, to the traditional mindset, that sounds like a terrible deal, but actually, it's a massive win. You are paying for pure protection without the expensive, unnecessary fluff of an investment attachment. Let's put some numbers to this. Because term plans are pure protection, and the company doesn't have to promise you an investment return, the cost is just incredibly low. A healthy 30-year-old can very often get a massive 1 crore rupee life cover for as little as 10,000 rupees a year. Think about that for a second. That's literally the cost of just a couple of pizzas a month, and it completely guarantees your family's financial future. It really is the ultimate shield.
All right, let's get into Section 2, the all-in-one trap hybrid policies. Now, what's super interesting here is how the industry aggressively tries to convince you to buy bundled plans instead. These hybrid plans, things like endowments or ULIPs, well, they try to be both the shield and the sword. But just like one of those 2-in-1 shampoo and conditioners, they usually don't do either job perfectly. When you pay a premium for a hybrid policy, your money immediately gets sliced up. A portion goes to the actual life cover. Another portion goes toward the investment bonus. But a surprisingly huge slice of your hard-earned premium goes straight toward hidden administrative charges, agent commissions, and mortality costs. Your money is literally being drained before it even has the chance to start growing.
Which brings us to Section 3, the reality of returns. Let's break down the actual math to show why the returns on these hybrid policies can be highly deceiving.
If you look at the historical data, traditional endowment and money-back plans usually only offer about a 5 to 6% annual return. In fact, if we look at specific data for some popular policies, like the LIC Jeevan Labh for instance, if the projected investment rate of return is at 4%, the actual internal rate of return for the customer can plunge to as low as 2.33%. Seriously, that is worse than a standard bank savings account. You are locking your money away for decades for absolute minimum growth.
And here is the real kicker. This brilliantly illustrates the silent wealth killer, inflation. Say your policy is giving you a 5% return. Sounds okay, right? But what if the cost of everyday items, milk, school fees, gas cylinders, is growing at 7%? Well, technically, you are getting poorer every single year. Your 5% guaranteed return is actually a guaranteed loss of buying power. You aren't creating wealth here, you're just slowly bleeding it.
Let's just look at the side-by-side comparison for a second. It really puts the whole thing into perspective. When you compare an endowment insurance policy against a pure saving instrument like the Public Provident Fund, or PPF, and then against a pure wealth creation tool like equity mutual funds, well, insurance falls drastically short. Insurance locks your money in with very low liquidity, jogging along at 5 to 6%. Meanwhile, PPF gives you a fixed, tax-free 7 to 8%. And mutual funds, they offer high liquidity with historical averages of 12 to 15% over the long term. And over a 20-year timeline, the compound interest difference between 6% and 12% is just staggering. It's basically the difference between merely surviving your retirement and truly enjoying it.
Now, I do want to give a fair assessment here. Hybrid policies aren't entirely evil. They have their pros and cons. The biggest pro? Forced discipline. Because your policy will literally lapse if you stop paying, it kind of forces you to save money regularly. They also offer tax benefits and a nice baseline peace of mind. But you really have to weigh those against some pretty glaring cons. We're talking suboptimal returns that totally fail to beat inflation, high complexity with all those hidden charges, and honestly, perhaps worst of all, low life cover. Because such a large chunk of your premium goes to the investment side, hybrid policies very often leave families woefully underinsured, sometimes with tiny covers of just 5 lakh rupees. And let's be real, 5 lakhs is simply not enough to replace a breadwinner's income today.
So how do we fix this? Section 4, buy term, invest the rest. This brings us to the definitive financial strategy for the common citizen.
Here is exactly how you execute this split strategy. Step 1. Buy a low-cost, pure term plan to get a massive protection cover. You secure that giant 1 crore shield for your family for just a few thousand rupees a year. Step 2. Take all the surplus money, I mean the thousands of rupees you would have otherwise dumped into an expensive hybrid policy, and invest it directly into a PPF or an equity mutual fund. By completely separating the shield and the sword, you ensure maximum defensive protection for your family while unleashing your money to actually achieve high-growth, inflation-beating returns. It's a total win-win.
To summarize what we've unpacked today, life insurance is a fantastic, absolutely necessary protection tool. It buys you peace of mind. But as an investment, it's mediocre at best. Investments are what actually dictate your future standard of living. Please do not let the allure of tax savings under Section 80C or the emotional comfort of a money-back guarantee cloud your financial judgment. You have to use the right tool for the right job.
I want to leave you with a final, somewhat provocative thought. The next time you look at your own portfolio, or when you put your hard-earned money into a financial product, ask yourself clearly, are you buying a shield to protect your family, or are you buying an engine to drive your wealth forward? Because if a product claims to do both, it is probably time to rethink your strategy. Thank you so much for joining me on this explainer, and I highly, highly encourage you to go review your policies today.